Hi, and welcome to our discussion on sales forecasting. Today we're going to talk about the role of sales forecast as related to business plan development. We're going to examine how to forecast sales, and we're going to introduce a sales pipeline approach. So there are many purposes and aims of developing sales forecast. One is that it answers the question that you're going to need within your business plan, and particularly within the financial sections of your business plan, of how much product or service are you going to sell, at what price, over what time, and what level of expenses or resources are you going to need to make that happen. This gives your investors and lenders insights into what is the financial future of your firm, and it should help you improve your business by developing some goals, tracking progress towards those goals, and understanding what it's going to take for your venture to be more profitable or successful. And so within financial statements, historically, they're based on historic data, meaning that they measure what happened in the past, what happened last quarter, what happened last year. Within your business plan, you're trying to forecast using these same financial statements of what's going to happen in the future. Looking at your revenue forecast, looking at your cost of goods sold, looking at your selling, general, and administrative expenses. What is it that's going to enable you to generate revenues, and what are the costs associated with getting there? So this is what forecasting is all about. How much money do you need to reach the revenue and profit goals that you have set forth? Bottoms-up forecasting involves taking a look at what level of funding do we have, or what level of funding do we believe we can reasonably achieve, and then how would we put that money to work, and what would be the outcome of that? Top-down forecasting is oriented broadly towards looking at the market in general. What is it that competitors are able to achieve? What's the broad market opportunity? And what percentage or what share of that do we think we could achieve over time? So what we want to do within our forecasting is connect these two. We want to recognize from top-down what the overall opportunity may be, but we also want to be thoughtful about bottoms-up, of what level of revenue can we achieve based on the resources that we can collect. So with forecasting, it really starts with understanding the income statement, of thinking about revenues, expenses, and profits, of estimating the revenues that you can generate per unit of product or service sold, and what level of expenses you're going to incur to get there. And so with your revenue forecast, what we encourage you to do is think about the products that competitors are offering, collect industry data, look at what you believe is a reasonable price for your product, validate that through some surveying and from some other things you're doing as you're developing your business model canvas en route to developing your business plan. And that should give you some reasonable estimates of what the revenue potential is and how to estimate cost that's going to enable you to achieve those goals. And again, we'll spend week 6 talking about financial statements in some detail, but I wanted to set the groundwork here for the types of things you're going to see in the business plan evaluations this week. So within planning and budgeting, there's a central principle of a sales pipeline that you should understand that's related to generating leads, planning and closing sales, building those relationships, and it will help you establish your sales budget. So by illustration, the pipeline looks like a long pipe, meaning that we have leads, and some of those leads are going to convert into a selling activity, and some of those selling activities are going to convert into sales. A fundamental element regarding sales and sales strategy is understanding how to identify and manage the sales pipeline. It starts with generating leads, and what we mean by a lead is a candidate customer for your product or service. Those leads may be cold called, meaning that you are sending them an email, you're sending them a mail piece, you are calling them on the telephone, or you are visiting them in person, and it's been unscheduled. It's unexpected. You simply show up and you hope that they will listen to your pitch. Now, I would argue it's better to do a warm call, meaning that there's been some advance preparation, there's been some advance appointment, there's been some advance material provided to them that gets them familiar with who you are and what you're about, and it allows you to introduce your product or service. Networking plays a big role in that. And what we mean by networking is using your relationships, both personal and professional, to help make introductions, to help make references. And by that model, hopefully you can use your network to be able to reach out and find candidate customers. And in that model, people are generally more friendly to hearing what it is you have to say. And hearing that is what we would call selling. And in the selling, you're able to actually go in and sell your solutions and not your products. So I believe customers are less interested in features and functions than they are about value and benefit. So you have the opportunity to go in and tell them about your solution. What's the pain that you're solving? What's the benefit that you're allowing them to realize? And so in that model, it certainly gives you the opportunity to get in, orient yourself with that customer, understand what their influences are, and also recognize that as you're selling, you're going to be told no many times. So in that way, not everyone is going to want your product, and not everybody is going to want to pay what you want them to pay for your product. So selling certainly has high highs and low lows, but be resilient and recognize that you're focused on closing the sale, and that's not always going to happen. But it's prefaced by asking for the sale. You may need to offer some payment terms or discounts. And early on, you may even want to preface trying to build a relationship with customers that will be seen as leaders, that will be willing to be referenced, that will be willing to be cited as users of your product. And in that way, it certainly will help you and go through and navigate this process of generating the leads, of selling, and of closing the sale. Building one-to-one relationships is very helpful, particularly if you have a higher price product. And so knowing the customer, studying that customer, setting up some type of databases or customer relationship management tools to manage that relationship is certainly central as you are able to build such relationships. You also need to establish a sales budget. So this would be part of your overall marketing budget. But what we want to recognize is that if we have a product and we have done our homework, we've set a price point of perhaps $10. We should be able to go through within our financials and recognize what are the expenses that are unrelated to sales and marketing. So what's it going to cost to produce the product? Are there other fixed or variable costs that need to be taken into account? But we want to recognize we may have $3 for profit in this example, not including sales, which means that we have somewhere between $0 and $3 to use for our sales budget. And so in that model, if we are forecasting 1,000 products sold in the first year at $0 to $3 of budget for selling that 1,000, then that would put our sales budget maximum at approximately $3,000. So it really is all about what is the product price, what costs are incurred with developing that product and bringing that product to market, and then whatever that difference is profit minus what we're going to spend on our sales activity. We also want to consider the lifetime value of that customer, not just that they may be a one-time customer, but if they're going to continue coming back to us. We want to be aware that it may cost us a little bit more to get them as a customer once, but that if we can have loyalty with them, we're not going to have to incur that cost over and over again. So think about, are you dealing with a one-time customer that may use your product or service very infrequently? Or if they're a frequent customer, you may lose money on them in the beginning. Recognize that you're going to make money back over time based on that initial marketing cost. And recognize too that the opportunity certainly varies depending on the product or service that you have. If you have a product with a relatively low price point of a few dollars or even a few tens of dollars, you may not spend a lot of time going out and individually cultivating customers one by one. You need to do some mass marketing. You need to do some broader advertising. But if you do have a more expensive product, perhaps hundreds or thousands of dollars per product or per service, that's something you can work to cultivate customers and spend a bit more of your face-to-face time with. So recognize that there's an opportunity cost of your time and that you are using that thoughtfully. So in summary, sales forecasting certainly drives your financial statements and your ultimate business plan. It's important to set revenue goals that you believe are reasonable and that you've got a strategy for reaching them and a sales budget and a marketing plan to get you there. And in that way, to set effective sales and marketing budgets, you need to understand how to evaluate and set your sales forecast, that you set your revenue goals, that you understand your other expenses, and recognize the role of sales and marketing and the criticality of them to your venture and to the ultimate success of the firm. Thank you.